This is John Shinal with Vader TV, and we're here today talking with Mark Mahaney, Citigroup's internet analyst, talking about the Yahoo Microsoft possible takeover. Mark, first of all, what you guys are telling people right now in terms of what this might mean for Yahoo. First of all, how likely is it that Microsoft wins this company and Yahoo becomes a part of Microsoft?
I think if you were a betting person, you'd have to bet that this deal goes through. Mm-hmm. Why wouldn't it go through? There's an alternate bidder out there. It's hard to identify one with the kind of balance sheet or the cash that could come in and make a serious offer for Yahoo. Secondly, it's hard to see somebody wanting to try to bid away Yahoo from Microsoft. Yahoo is extremely important to Microsoft strategically. Mm-hmm. Step back. Microsoft for 3 or 4 years has tried to be successful in online advertising. It's got about $1.5 billion of losses to show for its effort and single-digit share of the U.S. search marketplace. So they need round two. Yahoo, right, as part of round two is an obvious piece. The question is, if you got another bidder in there, do they really want to try to bid against Microsoft? Can they really match the resources? The other alternative is, of course, that this deal doesn't go through for regulatory reasons. We don't think that'll happen, but that's a very hard thing to handicap, right, particularly in Europe. So we think the odds are, we've pegged it at 55%, but 50, 60, somewhere in that range percent, right, that this deal does go through, probably at a somewhat higher price than the $31 bid that Microsoft initially put out there, mm-hmm, but the deal should go through, or likely will go through.
Now this week we had Microsoft saying they might go the aggressive route, the hostile route, the proxy route. At the same time, News Corp, the Journal is reporting that possibly they might get involved with stake in Yahoo. Both of these things were talked about before. But you're saying that Microsoft is the acquirer most determined and most able to afford the deal, basically.
Yeah, clearly. Okay. Clearly. And this is, they've obviously attempted to buy Yahoo in the past. Right. That has been disclosed at materially higher prices, which is one of the reasons, legitimate reasons, why the board of Yahoo is reluctant to sell at 31. Right. But this can be put to shareholders, and then shareholders will decide, what's the best alternative I have here for my stake in Yahoo, mm-hmm, and maybe they can get a better price. And arguably they can, under the simple rationale that Microsoft probably can't accept a no. I'm sure there's a price at which they will accept a no, but 31 they can probably accept. They will not accept a no. They will likely be willing to bid higher. But
is there a real danger, though, of Microsoft overpaying even in the low 30s? Because if you think about it, they're acquiring Yahoo, which has been losing share to Google, or at best not gaining anything. They're really the weak number 2 player in the online search ad market. So how does Microsoft buying Yahoo solve the Google problem, or maybe it doesn't, and Google is really just as strong as it's been before? I mean, what's your thoughts on that?
No, you make a really good point. It certainly doesn't convincingly solve the Google problem. I guess the other way to think about it is, what are the options? Microsoft clearly wants to have success in online advertising. They've been willing to pay very high premiums for that, either their stake in Facebook, right, or the price that they paid 30 times cash flow for Quantum. That was one of the highest premiums you ever saw, right, just across M&A land. So they're clearly willing to pay a lot. They believe it's one of their most strategically important growth areas. And step back, internet advertising is a pretty substantial growth area. We're at 7% of all ad dollars, right, online. That will double. The question is how quickly, but 3 to 5 years is a reasonable proxy or reasonable guess as to when that'll double. So it clearly is a growth market. Large companies are looking for growth markets. Yahoo, what does Yahoo give you? Yes, in some ways it's the deteriorating asset. They're losing, right, share in search. They're losing share in display advertising. But they still have a very large platform. And if somebody can improve the monetization and the marketing of that platform, it could be a real win.
You're talking about the content side, then, the platform, or still on the search side? In terms of what Yahoo looks like under Microsoft, sides. Is it a media company or is it a search company?
Yeah, both sides. I mean, it's obviously very large. It's one of the top 3 or top 2 destinations worldwide as a portal. Right. It used to be number 1, so hence the deteriorating asset, right, you've got to worry about. But it's still very large, and maybe in more effective hands, maybe with a combination of different assets. Microsoft has some geographic areas where it's relatively stronger than Yahoo, arguably in Europe. Maybe you fuse together the best of both worlds. You can create, maybe 1 + 1 can equal more than 2. And particularly, you've got 2 search engines here. Step back 2 years ago, Yahoo powered search on both of those sites. Right. You could go back to having 1 search engine powering search on both of those sites. There'd be advantages to that for advertisers and advantages to that just in terms of scale.
Right. The problem there is just how much Yahoo and Microsoft have both spent on a lot of assets. A lot of those obviously would have to be written off because there's a lot of duplication there, I think. So we'll continue to watch it, and appreciate the thoughts, Mark.
Thanks, John.
I've been speaking today with Mark Mahaney, Citigroup Internet Analyst. For Vader TV, this is John Shinal.